Welcome, you're listening to the best of investing on Talk 910. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, here's our format. A few guys sitting around a bar having drinks. Without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Lou Botmall of LPL Financial, our financial advisor. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station. And then today's trivia theme is the cartoon The Simpsons.
Nice.
Nice, huh? Okay, now, Lou, you got a lot of good information for us, so take it away.
Well, it's December. I hate to tell everybody, but it's the silly season. We're all winding down, and right now is probably one of the best times to start your year-end and future year plan when it comes to financial planning. But what you do in the next couple weeks can have a tremendous impact on your taxes. And
I knew you were going to talk about tax planning.
tax planning is a big part of financial planning, and
it's important. We got to talk about it.
Mark, I will tease you a little bit. At the end, we'll talk about the new tax system, net interest income tax, which I don't know if you know about. That's the third tax system on top of W-2 income or 1040.
Yes.
AMT taxes, and now we have the net interest income tax. Some are calling the Obamacare tax on the sale of homes.
Yes.
So they're coming after that one pretty good.
Yeah.
But we'll maybe set to the end, tease a little bit. But so the real thing here is, do you have a plan in place? Have you been saving money throughout the year? You need to do a head check right now and say, what have I been doing? What am I going to do into next year? Because people, financially have been doing better. So review your goals, check your plan. And if you had one in years past, dig it out and take a look. I mean, we've had some bad economic years, but things are starting to improve. And now you got to start thinking ahead a little bit and behind as well. What I mean by behind, I mean behind in this year. We have a couple weeks left. So look at your income. Are you going to get a bonus? Okay, if you're getting a bonus, are you going to defer that into your 401k plan? Okay, everyone has a little partner out there that we work with called FICA and FUTA. They appear on your paycheck. Ever see them?
No, not FUTA. It's Medicare.
Medicare, well,
Because
yeah.
FUTA is federal unemployment.
Right.
It's paid by the employer.
Yes,
but I know what you mean.
Yeah,
but basically, it's Social Security.
Our paycheck friends.
Yeah.
So you can defer our paycheck friends.
Well, what most people do, they get their first paycheck. Who's FICA?
Yeah, exactly.
And how did he work for me? Go ahead. All right.
But the idea is that if you put money or your bonus into these plans, okay, into the 401k plan, you don't pay tax. You don't pay those taxes.
So not only do you avoid income tax,
correct,
but you also get out of paying FICA and Medicare tax by money that goes into your 401k.
Right.
That's a pretty good deal.
And if you're self-employed, think about doing a SEP IRA. Now the difference there, or a personal IRA you can do as well. The big difference here is a 401k has to be funded by year end.
Yeah.
So we have only a couple of payrolls left. You want to work with your payroll department, maybe slip them a bottle of booze or something like that. Say, look, on the last payroll check, I want to do X, Y, and Z. You can actually, in most plans, defer all of your income in your last paycheck.
Yeah.
You have enough savings, you made it through Christmas, why not put some money away?
What do you know what the limitations are? Like
$17,500. If you're over 50, it's $22,500
Is it a percentage at all? Or is it
no,
it's
flat numbers, yes.
Okay, and then also what I like though is that if you have employers who do any kind of matching, that's free. That's free money.
It's free money, yeah. And people are starting to ramp that up again. It's been a slow process, but I control some plans. And I have some other clients, and we're starting to see maybe a 3%, 4% match. So take advantage of that. So
and at this time of the year, we're in December. The money we're getting now, it's all at the marginal rate, meaning we're paying our top tax rate on that money. So if you don't need it,
yeah, absolutely,
defer it.
Yeah, and then if you're doing more planning and you're employed on a personal level, 1099, think about a SEP IRA. You don't have to fund that till you actually pay your taxes, which could be April 15th or next October. Yeah. If you're a corporation, maybe I should do profit sharing. Again, you have to fund that till you file your taxes. So start thinking ahead right now. If I have extra money around,
but if you don't have a corporate plan though, you do have to set it up by the end of the year. You just don't have to fund it.
That's why you need to call a professional in right away, and then other people. I actually am working on 2 plans right now, year-end plans. If people say I want this year going into next year. So it's really important that people start thinking ahead. And also the other big thing is capital gains rates have changed. And everyone's made a lot of money in the investment markets this year, and people made a lot of money in real estate. So start thinking about what's my capital gains impact. So
what are the rates and tiers right now?
Well, this is the tough part, okay, is that everyone's income is going to affect their capital gains rate like it hasn't in years past. So we're used to the 15 and the 9.6 here in the state of California. That's going to 20 for most people in 9.6. So
Wait a minute, for California?
well, it's a federal rule. Everyone thinks 24 in California. Now you got to start thinking 29.6.
Oh, the 20 plus the 9.6.
Plus the 9.6,
okay.
yeah. So everyone was like, oh, it was easy. It was 25% before almost.
Oh,
Now
yeah.
it's 30%. So you got to start thinking ahead. And what I tell people is there are some investments that haven't done well. You can sell those investments by the end of the year, and they have losses in them. That's called a capital loss, and that can go against a capital gain. Also, any capital loss up to $3,000 can be deferred against your income in the next year. But more importantly, you need to bank these gains whenever they occur. So maybe you invested in something that didn't work. Hey, sell it, bank that loss, so against future gains in future years, it carries forward. But also you can go against gains you have this year. Some people have them in real estate. Some people have them in their investments or their investment portfolios.
And you have some information about real estate too, don't you? About
all right, so this is the big thing that everyone's called this the Obamacare tax or the Obamacare tax. It's a 3.6% tax increase. It's a net interest income tax. So think of it this way: we have 3 tax systems now in place, like I just mentioned.
Yeah.
We have the ordinary income tax that we're all used to. We have AMT taxes, which has never been indexed for inflation, right?
Right. Yeah.
So everyone's fallen into that AMT limit. Even if I have people who are single, they make very little money to pay AMT tax.
And it used to be AMT was structured originally for people doing tax shelters.
Right,
Now,
super wealthy.
everybody's kinda-
Yeah, I mean, it's all offshore and all stuff. And they're not removing it because it's easy tax for them
Yeah.
because no one really knows about it unless you're making money.
Yeah.
Now we have the net investment income tax. Now this is on a single person over 200,000, married, filed jointly is 250. So it's the adjusted gross income tax, excluding foreign earned income, includes among other things wages, compensation, distributions from non-qualified deferred compensation, alimony, taxable Social Security income. So if your income's over these thresholds, you can be back up to that Bill Clinton tax level of 39.6
Ouch.
with an NII tax, we call it. And that is a separate system, separate calculation. Call your tax planner now because there are many offsets to this tax. You have to make sure you're not close to that threshold, and people should be nervous because this is going to surprise everyone saying, you know, I talked to some accountants already, they're like, I can't call my client, so you're going to pay another 3% on your money because
Yeah.
they're going to go crazy. And
And
it's
it's
out
on
of nowhere.
It's on the net
On the
interest
and net interest investment income.
or investment income.
Net
right?
net interest investment income. That's what it's on.
Is it strictly on interest?
Yes.
So
This is
if
not
you
passive
sell-
activities.
What about selling real estate?
Selling real estate's right in there,
Right,
right in the
okay.
wheelhouse. So
So-
some people have said if you sell your real estate, you might pay the Medicare tax or medical tax for Obamacare, which can be true in some cases. I'd say it's more indicative in California than it is in other places because people can make a $500,000 on a home in California.
But it's based on your modified adjusted gross income. There's probably a calculation.
There's a calculation in there, but it's very complicated, and this is a third tax system. We already have 2. This is a third one. So imagine when you do when your accountant does your taxes and they hit enter on their computer,
Yeah.
it does 2 calculations now. Now it's going to do 3, and some people does not know this is there.
Yeah.
Amazing.
So
Probably gonna be 4. Okay, we're gonna
Yeah.
cut to a very quick commercial break. Again, the theme is the cartoon The Simpsons. Lou, this one, we're gonna see if you know this one. Are you a Simpsons follower?
Yeah, back in the 90s.
90s, yeah. Okay.
It's been on a while.
What is the name of Homer's neighbor who usually says, "Hi diddly doo"? Hi diddly doo.
I got to log in real quick.
Yeah. 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. The Best of Investing will be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanf and Lou Botmal. When we cut to the first commercial break, we ask this trivia question. Again, the theme is the cartoon The Simpsons. What is the name of Homer's neighbor who usually says, "Hi diddly doo"?
Is that Flanders?
That is Ned Flanders. Very good. Okay, Mark, you got a couple articles you want to share with us?
Well, this one I pulled off the Wall Street Journal, and I absolutely can't believe this because listeners to this show know that we have pounded on the Dodd-Frank bill that was passed over 2 years ago now because of the resultant flow of regulations. And in fact, starting in January, yet another layer of regulations are being added on, piled on, I should say, to the mortgage lending industry. And my company is Pacific Private Money. We make privately funded real estate loans, and it used to be that our industry was not regulated for the most part, and now through this gillnet approach that the regulators have just been keying off this legislation, they're just pulling in all these outside industries that really were not part of, nor responsible for, nor really in the same room with the companies that caused the mortgage meltdown and the whole subprime mess. And so none other than Barney Frank himself, and it says here,
Dodd-Frank.
of Dodd-Frank. Retired House Democrat Barney Frank is the last person on the planet you'd expect to criticize the implementation of the 2010 law that bears his name. But there he was at a recent event hosted by this trade group, suggesting that regulators ought to focus on the banks instead of some of these other companies that and industries that they are going after. So he was quoted as saying that they're overloading the circuits, and that's not a good idea. And that his intent was to regulate the institutions that clearly needed to be covered, which were the large banks, and not some of these other industries that they're going after. So even the man himself, the man whose name we've taken in vain many times on this show, Franken Dodd, so I just, my head wants to explode when I think about this. It just goes to show you that these people don't know at Congress at the highest level that are responsible for regulating our industry. They don't know what they're doing. In fact, at the end of this article, it talks about, it pulls a quote in from Nancy Pelosi. Nancy Pelosi famously said that Congress had to pass Obamacare to find out what's in it.
Love that.
Wow.
And so, and it's related to this because that in many ways is exactly what happened with the Dodd-Frank regulations. They had to pass it, but nobody knew what was in it. No one really read the 2,500 pages of law and text and gobbledygook that was in there, and now you've got these non-elected government officials, which make up 99% of the government is these non-elected officials at the GSA and elsewhere that are sitting there doing nothing but trying to figure out how to implement via regulation the intent of whatever the intent was of the law here.
Wait, are you telling me that you don't like the policy of first just passing a law and then just figuring out what's in it? I don't know, that sounds like pretty good policy to me.
And not only that, then coming up with layers and layers and layers of regulation that, in theory, will, follow and cover the intent of the law. And so it's making law after the fact here. And I just find it interesting that Barney Frank really meant to just put a damper on the banks, the large banks, so that we wouldn't have another subprime meltdown, which almost took the government and the whole economy with it.
Yeah.
And yet now, industries like, our own private money loan origination, where we make loans to real estate investors who are only trying to do good in the economy by buying, fixing, and flipping distressed property. But oh no, now we're regulated up the yin yang too, thanks to Dodd-Frank. And so it's just crazy. So anyway.
This is not going to end, and unfortunately, most investment companies I work with now are actually hiring political consultants to tell them where the laws are going and how things are going to work and what they're going to be at the end and what the political climate's going to be from year to year. So this year they're saying, oh, this is a clean year because it's an election year, right? So 2014 is election year.
Mm-hmm.
During the midterms, they're sitting there going, well, look, no one's going to upset the apple cart this year. You're not going to have any debt ceiling debate. You're not going to have any really problems going into next year because they don't want to lose their jobs. If they have another standoff like they had at the end of last year over the Health Care Act and all these tax laws, it'll be over for those politicians or their parties. So
yeah. And Lou, you just talked about in the last segment how we've got two new or a new set of taxation that's coming in that affects real estate investors in two ways. One is through the interest income for people who, in my line of work, like to participate in high yield, high interest paying notes. And also if you're a real estate investor or anybody who owns real estate, which is, a large segment of a lot of people, a large segment of the population. If you sell real estate now, you're looking at possibly this additional tax. That's on top of the fact that beginning January 10th, you've got the new qualified mortgage regulations going in. There's a lot of things happening in 14 that are not going to stimulate the real estate market that are actually going to dampen the real estate market. And it's not like the real estate market is on fire right now. I mean, some people
No,
might
it's
think
hovering.
it is.
It's
but
hovering. It's doing okay.
It's really not.
Yeah. It's doing okay in pockets, but everyone's, and we need housing makes up, 25% of GDP?
Yeah.
We need housing to make the economy go. It's a key ingredient.
Right, what we need is new housing starts. We need the construction industry for new home construction to take off. That's what needs to take off like wildfire, and it hasn't happened yet. And now we've got, a slew of new regulation and taxation coming next year that is not going to stimulate the construction industry and the real estate market. So I'm not saying that real estate won't go up in value in 2014, because again, in a lot of pockets it will, mostly because of supply and demand. There's not enough new supply, therefore, but yet there's demand there, particularly in the Bay Area where you got people making a lot of money at these .com companies, and so that's going to push up housing prices. But that's really affecting people only at the very top. But the vast majority of people who would rely on the economic growth stimulation from a strong construction market. That's
Not there, yeah.
It's not there yet, and I just don't see how this is going to help.
Raising interest rates not going to help either.
Yeah, no, that's not going to help. So, for those reasons, so here we got taxation, we've got new regulations on mortgage lending. I think that there's a possibility that we're going to see stagnation in real estate and possibly a drag on the economy, which only means that interest rates aren't likely to go up. So if you're a saver and you're waiting for your CD rates to go up, that's not likely to happen in the next couple of years. The Fed might find themselves forced to, keep their foot on the pedal with quantitative easing. I mean, there's just a lot of stuff a lot of implications here that.
To your point, to back it up, most analysts are saying right now that the Fed funds rate, so we have this quantitative easing issue where that's money coming to the economy, they might try and taper that or bring those down in a very slow basis over the period of the year. But really what's going to happen is the Fed fund rates are not going to go up to like 2016. Yeah. So that's going to be around 25 basis points, which will artificially also keep rates low during this whole period, which is, again, going to affect savers. Where are you going to find yield in that environment? Remember too, there were bonds that were sold for 7% back in 2007, 2006, 2005. Those start coming off after 10 years. Yeah. They're retired. Then where do people go? And all the new debt's 2%. Who wants to invest in that stuff? Insurance companies use that as a part of their portfolios. They're really having problems right now, saying, where am I going to find my yield to live up to the expectations I have on income in the future? This is really a problem.
Yeah, because a lot of those insurance policies, people
right.
were
They write on
get a certain income from that.
Exactly.
So while the low mortgage rates are good, for a facet for the real estate industry, it's not always good. There's always two sides to the coin, but when you figure that we've got a baby boomer age, we're all starting to get older and into retirement. We're supposed to be moving into more conservative investments like stocks and like bonds and CDs and those types of products that are not paying anything in terms of interest. And so we've got an aging population that, for the most part, I include myself in that, and most of us are really not on track to retire successfully at this point. And so, you're looking at low interest rates into 2016. Again, I have a solution for that.
And so does Lou. In fact, we got some very good emails for both of you that we are going to share in the next segment, because that's what the listeners hanging on their chair going, well, what am I to do?
That's why we're the best of investing.
That's right, exactly.
Talk about the solution to that problem of continuing low savings rates as far as the eye can see.
So this question, what is the name of the clown on The Simpsons? I'm guessing there's a lot of kids watching the show.
I think the clown in Living Color, that clown was better.
I'm trying to remember that one.
Homie? Was it Homie the clown?
I don't remember.
Yeah.
Okay.
Homie, yes.
Call 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. The Best of Investing will be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff and Lou Botmall. When we cut to the second commercial break, we ask this Simpsons trivia question. What is the name of the clown on The Simpsons?
That'd be Krusty.
Very good. That would be Krusty the Clown. Okay, Mark. Now we'll go from the humor to the serious now.
Yes.
Okay, so here's an email we got from you, and it's kind of interesting because it kind of follows what we were just talking about. How does your underwriting guidelines compare to a bank's? That's a good question.
So when the listener says yours, what they mean is how do private money loan underwriting guidelines differ from a bank? So my company is Pacific Private Money. We're based in Marin County. We make loans primarily to real estate investors all over California. The classic loan that we make, the kind of the bread and butter business that we have is making loans to people who buy, remodel, and then resell, also called buy, fix, and flip, real estate in the Bay Area. In fact, the private money loan originators, the private money lending industry has really been born in the last 5 years after the subprime meltdown, and it's been the major and primary source of funding for that segment of the industry, because when the subprime meltdown occurred, one of the things that banks did is they pulled back on lending on non-primary residence acquisitions, meaning they're not making loans to real estate investors. So whereas in 2005, if you had a good FICO score, you could fill out a loan application, plug in any numbers you want, and you could buy homes 100% financed. And I know people who did that
in some cases. I remember seeing advertisements you could buy 120%.
Right, absolutely. Right. And so that's not happening anymore. So here we are in 2013, and banks generally are still not making loans to real estate investors. So how do our loan underwriting guidelines differ? Well, a couple of different things. There's really three things that we bring to the party when a real estate investor calls us and says, hey, I've got a property in contract and I'd like to apply for a loan. Number one, usually they need to close quickly because we're in a tight market, and the guy that gets the contract is usually the guy that says, I'll close in 2 weeks. Rare is the closing contract nowadays on a non-primary residence acquisition. Rare is there a contract that goes 30 days. Usually it's 21 days at the most, and it's not uncommon for it to be 2 weeks, maybe even 10 days. Now, banks can't accommodate that quick guideline. No way. So that's one. And then number two is many times the real estate investors do not have the credit scores that the banks are looking for. And in fact, the average credit score I heard, Robert the other week was saying it's now 720 on loans that are closing. I mean, it's pretty darn high. And I have a lot of clients they don't have bad credit, but their credit's in the mid 600s, maybe the high 600s, because they may have had a foreclosure or a short sale.
Or sometimes if they just have a lot of debt,
or if
it's investment debt,
right?
No, and there's nothing wrong with them.
No,
they
pay their bills, but
exactly.
That's high. Yeah.
And then number three, the third one would be sometimes the condition of the home is such that the bank, it's not bank financeable, because some of these homes are in a condition that would not pass home inspection with the flying colors that the banks, oftentimes
like
need.
Missing a roof. No, I'm just kidding.
Well, sometimes they're damaged inside. They're missing, right? Even missing a heater. That's simple things like that. It's not bank financeable. So that's part of our underwriting guides. The second part of our underwriting guidelines is that we are not FICO score based. We're not credit score based. So while at Pacific Private Money we do pull credit on every single applicant, bar none, without exception, we don't make the final decision, and generally we don't base the decision on the score. But I do look at the nature of the credit. If their score is hit, and it's hit because they have some unpaid medical bills, or they had some short sales or foreclosures, but all their trade lines have been paid on time, that to me is a good bet. I can back a borrower like that. But if they show signs of laziness, they're not making their monthly payments on a recurring basis, why would I think they're going to make payments on my loan? And so oftentimes we'll decline a loan like that. So again, it's not the score so much as the nature of the credit. And then we also don't have to underwrite their income. That's not required. A lot of real estate investors don't actually have regular income. They make profit on a deal-by-deal basis, and it's not W-2, it's not, provable or reliable income from an underwriting standpoint. So the bank, when they need to, have verifiable proof of income, they'll look at tax returns, they'll look at W-2s, they'll look at other forms of income, and they'll do all this underwriting and come up with debt-to-income ratios and all this stuff that we don't have to worry about that kind of stuff.
Well, also the thing is, people, not everybody is very honest on their tax return. So they're going to show probably less income, and it'll be on their tax return and pay very little tax.
Well, as an aside,
Yeah.
I'll just say that I'm not a big fan of an applicant who calls me, and if I ask for their tax returns, which I don't always do, but sometimes I'll we will, depending on the situation.
Yeah, you can tell a lot from the tax
and they
return.
might say something to the effect of, well, I don't show all my
Yeah.
income on my taxes.
Yeah.
And then I have to start thinking about the integrity of the person
Yeah,
that's on
exactly.
the other end of the line. And
Yeah.
so here's the last part. It's related to what I just said just now, that is, really part of the private lending industry and not so much the bank. When you apply for a bank loan, you are literally a set of numbers. Unless you're going to a community bank and you have a relationship with them, that might be different. But if you go to any of the major banks, you are a collection of numbers. You are your income, your FICO score, your debt to income ratio, etc. It's not about the story. But in private lending, if I'm talking to a guy and he starts saying stuff on the phone like, well, I don't report all my income and I got all this income property, but it's in, other names, and if I start,
or I'm constantly suing my attorney.
if I don't, right, if I don't like what I'm hearing, guess what? I'm going to say no.
Yeah.
I don't have to make anybody a loan. We can discriminate.
You can discriminate.
We can
yeah.
discriminate. Now
Yeah.
we don't discriminate based on
Like race or something.
race and sex and all of that stuff. But if we don't feel comfortable with that person, look, we're lending out people's retirement savings. That's the source of capital
Yeah.
at Pacific Private Money and other private money loan originators. Our capital is not from banks; it's from private individuals' retirement accounts that people are enjoying 8% yields and higher on their money by funding our mortgage pool fund, which makes loans to real estate investors. And so, I have a fiduciary responsibility to protect that capital. And if I think someone's squirrely, if I don't like the sound of his voice, guess what? Hey, you know what? I can't help you, but I think I may be able to refer you to another company that might. Send me an email. I'll shoot you a couple of referrals, and good luck. So, again, we have the ability to do that in this industry, and I like that. I think that's a good old-fashioned way to do banking. I want to make loans to people who I know have the ability to
Well,
trust.
that bears out in what is your default rate.
Well, it's next to nothing. I mean,
Yeah.
it's less than the banks. That's for sure. So, and I'm not talking about the hard money industry of old, where every other loan failed. I mean, we're in a completely different business model where we're making conservative, no more than 70% loan to value loans to real estate investors, and our
You're
default rate-
basically making bank loans that banks just don't have the time to make.
We've had less than 2% default rate on over 600 loans that we've originated since
But
2008.
here's the key
And
question.
no one's ever lost money.
That's the thing.
Yep.
Nobody has ever lost money
Yeah.
in those loans.
That's
Right.
what's key.
Sure.
Okay. So how do people get a hold of you if they want? And what's your fund right now? What's it paying?
So, we're our fund is paying over 8% right now. The third quarter distribution was at an annualized return, a simple interest of 8.9%, and those of my shareholders who are deciding to allow that to compound and not take distributions because they're using their IRAs and to fund to invest in the fund. They're getting a little bit more, so they'll be a little bit over 9%. So I talked about in the last segment that we had the answer, or at least an answer,
answer,
an
yeah.
opportunity
Yeah.
for people who are frustrated by the low savings rates, the low bond rates, the low rates, being paid pretty much across the board for this type. We've got safety and security features that I think are unmatched in comparison to other traditional investments. So it is an alternative investment strategy, and there are risks, but it's worth looking into. I mean, you owe it to yourself to check us out.
Check it out. Great. We're going to cut to our third commercial break. When we come back, Lou Botmall is going to give us some advice about recommendations for growth. A lot of people are
Yes.
interested in that. Okay, again, the theme for trivia is the cartoon The Simpsons. What is the name of the guy who runs the Quickie Mart, who has been known to say, "Please do not feed peanuts to my God"? That's when someone wanted to feed peanuts to the little elephant that they had on the display there. And don't touch that dial! When we come back from commercial break, Lou Botmall will be getting into investments recommending for growth. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Onf and Lou Botmall. When we cut to the third commercial break, we ask this trivia question regarding the cartoon The Simpsons. What is the name of the guy who runs the Quickie Mart, who has been known to say, "Please do not feed peanuts to my God"?
Is that Apu?
Apu, very
Yes.
good.
Apu for
Appropriately Apu. Lou, we got an email from a listener. It says, with the stock market seeming to be somewhat stagnant, what are you recommending for growth?
Can I recommend punting?
Yeah. Is this football? Yes, go ahead.
Exactly. No, so that's a good question. We've seen in the markets this year a miraculous year by most standards. I mean, you're up in the equity markets, depending on your measurement, over 20% across the board for many of the investments out there. And I think moving forward, there's a positive outlook. I mean, Mark was going into the housing outlook, which is tough, but it's still solid. And for everyone, like I mentioned earlier in the show, look at where you made money this year. Okay, winners always rotate. Okay, that's the theme you want to have in the back of your head right now. Winners always rotate.
Meaning like if bonds is 1 year.
Bonds
then maybe
1 year,
something
stocks,
else.
large cap stocks versus small cap stocks versus international stocks. It's all, everyone goes, why do I allocate? Well, the allocation idea is you need to really take a look at all the different asset classes. If you don't have those different asset classes inside your portfolio, you won't get 100% of the return of all those asset classes. So when I'm discussing this, the reason why I'm bringing it up is large cap stocks,
Okay.
small cap stocks, mostly domestically, made a lot of money this year.
Yes.
So you guys sit there and think, well, they might do well next year, but they won't do well as some other investment. What's that investment going to be? I'll tell you right now, it's not going to be bonds. I'll give you one example real quick. Okay, this is going to scare you a little bit, so strap in, all right?
I'm sitting down.
I'm ready.
Okay, so
I can have my headset on. Go ahead.
listen to this stat. Okay, so in 2005, how much money did it take to generate in a 2-year bond market to generate $100,000 of income? Your net investment, you had this balance in your
In
account
2001?
in 2005. 2005, not that long ago, 8 years ago.
Okay.
$2,851,000 yielded you in a 2-year Treasury bond, $100,000.
Okay.
Okay,
Sounds okay.
Not so exciting, really.
not so exciting, but still $100,000, $2 million.
Yeah, but
2 billion. Okay.
Right, it's
How
safe.
much would it take now in a 2-year bond to generate $100,000 of income?
4 million. I'm guessing.
42 million.
I'm close.
Oh
Really?
my God.
I have it here. It's in writing. That makes it right. No, actually, an analyst did that. It's a really great example. This is the 2-year Treasury
Wow.
bond. This isn't the 10-year. This is the 2-year. Remember, these rates are down below a point, right?
Yeah.
Right,
Yeah.
sure.
What is the yield on a 2-year bond?
I think a 2-year. I think the other day it was like I think 1.07 or I forget. It's fluctuated a lot. I mean, what's a 10-year? 2.8. 10 years 2.8.
Yeah, but 2-year, if it's 1% for 100,000, that would be 10 million.
Right.
Yeah.
Think about that.
Wow.
That's
So-
amazing. The reason I said 2001, I had 2001 on my mind only because I read a stat just recently that if you adjust for inflation, the market
Is at a
as
triple top.
as it approaches 16,000 is about to equal where it was in
2000,
2001
yes.
at the high.
We're sold at 26 times earnings, and now we're back to 16 times earnings. So we're actually earnings have grown up, but to this overall point is that you're
Yeah.
not going to get. Don't take this year and say I'm going to get out of stocks and into bonds. Bonds will provide a yield type return, and those things you're yield for. Mark touched to earlier. You have to take on a little bit more risk. So you're looking at stuff that's maybe strategic in positioning, like short duration bonds, but those are close to those 2-year treasuries. Then you get into a longer duration bond, and if interest rates change in longer duration bonds that go out 10 years, and you're holding a bond right now that matures in 10 years, and bond rates go up between now and that 10-year period,
Well,
you
you're
will
gonna
lose
smoke.
value potentially,
Yeah.
even if you hold it to maturity.
And gold's been getting kind of smoked.
Gold's been kind of getting smoked too, which means there's not a lot of inflation on the horizon. That's why interest rates will stay low for a while.
Yeah.
So I'm saying you don't want to rotate out of stocks into bonds. I think, and what I'm talking to my clients about right now is moving into more international investments, international large cap companies. Remember, Europe is turning around. We've kind of what do they call it? Jump the shark, as they say in Happy Days.
Oh, yeah.
We've jumped the shark really in the U.S. markets right now. But overseas, they're still working through a lot of problems. I mean, it wasn't but 2 years ago that Greece was going to go under and sink into the Mediterranean, and so did most
Portugal
of
and all
those
that.
most of those Mediterranean states. They call them what do they call those? The resort states
Yes.
of Europe were bringing it down because they overfinanced Portugal and Spain and all those problems. And
Do you like international funds? Or?
I do like international funds. I would say, maybe small cap versus large cap in the international space, because what people this year, actually you saw it mid-year in fund flows, people started taking out of Procter & Gamble or stocks over here and started buying the equivalent of those stocks overseas.
Interesting.
And everyone's doing business all over the world now. I mean, emerging markets are another example. And if our currency stays in certain ranges, you'll probably see a big bump in the emerging markets.
How did emerging markets do in 2013?
Not well. Actually
Okay, so-
flat.
Okay,
So that's not a winner.
No, but like you said,
Yeah.
it's a rotating type
It's
thing.
a rotating,
Maybe it's
yeah.
time for them to.
Exactly, and I'm not saying
Okay.
take 40% of your allocation and go to emerging markets. I'm saying trim some of your gains, as I've done for some of my clients,
Mm-hmm.
and buy something that's cheap. And you got to look for things that are on sale, and if you don't rotate out of things, you're going to end up
So you're
stagnating.
not a stick your head in the sand type of guy.
Absolutely not. I mean, a certain amount of this is passive, and I'm not
Yeah.
recommending trading monthly, daily, or
Daily,
weekly.
yeah.
I'm just saying look at your allocation, because this is the end of the year. Everyone goes, I'm going to do that when I have time.
Really, you don't
Look-
like day trading and load funds from one mutual
No, I do
fund
not.
to another?
Not at all. Not at all. And I will say this, December 26th, I bet you is not going to be busy in everyone's life where they're going to be kind of, hey, what should I be doing? We have this is one of those funky calendars. It's a very short season between Thanksgiving and
yeah.
Christmas, and you have those 5 days after New Year's, which is going to be kind of a slow weekend. The 5th is when things really kick off. You look how the way the calendar works this year.
Yeah.
Take that time to sit there and say, hey, look, what's my allocation like in my 401k, in my retirement plan? What do I need to check up on? What's my taxes going to be, this year? What's my income going to be? But more importantly, this allocation thing is you have to do something, because you can lay stagnant for a while, and that won't help you in the long run. If you see a 10% return in one market and a 5% return in the other, where are you going to be happiest? And the answer is, by doing that rotation, hopefully you'll capture that. And asset allocation is a big component. I'm not saying get out of everything and get into something else.
Yeah.
Reallocate. Take your gains somewhere. You get what we call swelling effect, where things get bigger in your portfolio. We'll trim some of that and put it someplace else that has gotten smaller last year, but not bonds, unless you're strategic.
Okay,
or high
well,
yield.
you got a lot of good information.
You're right about being nervous. I mean, you just listening to you, Lou, that is scary. And again, just kind of going back to the realization of how many people are entering into retirement, and the number of people entering into retirement each year, this year, next year, the following year, is getting larger and larger.
Those baby boomers are booming.
And it's just the worst time to be hitting retirement right now in terms of being able to count on
Passive income too.
passive
Yeah.
income, right?
Right.
In order to be able to count on earning a sufficient yield that we need so that we can live comfortably in retirement and not end up being in a situation where we're forced to eat Alpo.
Yeah,
Right. No, I
there you
mean,
go.
and yeah, that's right. 13,
All right.
Yeah.
All right, here's our thoughts for the day. Thanks, guys,
My
for your
happy
great
thoughts for this.
information.
I didn't mean to end on a sour note.
That's okay. Here's our thoughts for the
Get you a
day.
love
Coffee
Alpo.
next time.
Okay, ready? I'd give my right arm to be ambidextrous. I don't know if you thought about that. And my daughter asked if she could see a 50-cent concert. I said, sure, here's $1. Go take a friend. I don't think it kind of works that way, unfortunately. Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, your host, wishing you the best of investing. So long. Welcome. You're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, believe it or not, we have a lot of new listeners. Few people sitting around a bar having drinks without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, Catherine Harris, CPA of Karate and Karate. We got to elevate the education here, so we have a CPA as one of our co-hosts, and Robert Schiff of RPM Mortgage. Our phone number is 888-912-1190. Please write that number down. 888-912-1190. You writing that number down, Robert?
Do it again.
888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. And today's trivia theme is the movie A Christmas Story. Do you remember that from 1983?
Very appropriate.
Oh,
Yes.
of course, because we're coming into...
And every year thereafter.
Yeah.
Maybe Catherine will get some of the questions
Yes.
right this time.
That's yeah. We always tease her.
I don't want to tell you what year I'm born in.
No, that's true. That's true. Okay, and now Catherine, why don't you start off, because you were talking about predictions for 2014, since we are the last day of November. By the
Yes.
way, happy Turkey Day for everyone, and Black Friday.
Yes.
Hopefully everyone got
And
their
be
stuff.
ready
Speaking of which, I'm
for-
still full from, I don't know about you guys, but what's the deal with,
now the stores were open on Thanksgiving. It used to be like you couldn't even go grocery shopping
No.
on Thanksgiving. You had to have everything, purchased by Wednesday. Then everything was closed on Thursday, so all the families could get together. And then you had the Black Friday thing. Well, now they're just
Which
like
used to happen at 8 a.m. on
right,
Friday.
8 a.m. And,
Yeah.
and now they just
Now
they're
it's,
open.
now it's
What, Thanksgiving is
3:08.
7
Now it's
Yes.
3:08.
Yeah.
3:08. Yes, exactly.
And then there used to be Cyber Monday, but now every day is Cyber Monday because, who doesn't buy lots of stuff from Amazon and Zappos and all
Well,
those
it's
great
because
places.
Thanksgiving is so late, there's fewer days for Christmas shopping, so they have to get started.
That's
immediately.
not
They're all the
reason.
same.
Well, that
No,
sounded
it's-
good, didn't it?
That sounded very
Didn't that
good, but
sound
I saw before Halloween they started putting up the Christmas decorations.
Yes, well, and all the sales they're offering online now.
Well, and
It's
Walmart
everywhere.
was, the stories about Walmart is that their sales are down, and there's all kinds of articles written about why
Competition.
that might be. But for them to be
Oh.
open up on Thanksgiving.
You know what they should just do? What I do is
Sales.
keep the Christmas lights all year round.
Yes.
Just keep the Christmas decorations all year round.
So that's how retail deals
Dress
with
the
it.
holiday for the holiday that's appropriate. So for Easter, Santa's gonna be dressed up as
As a
an Easter
bunny,
bunny.
yeah,
Yes.
and-
Well, holidays only serve the retail industry anyway, right? I mean, that's why we have holidays is for
Yeah.
consumerism. And
Yes.
That's everything's been consumerized. So it's just support your local economy. Buy.
Well, do you remember Seinfeld, Festivus?
Festivus, yes.
With the pole and everything?
And they now have, which is actually I support it, is the local businesses on Saturday. So now that they have this
Yeah.
Oh, that's cool.
the Black Friday and this
Yeah.
Black Monday, they're now offering the
Local Saturday.
the local Saturday.
See, that's before Cyber Monday. That way you save some money by doing the Saturday so that you
Yes.
support the businesses. So, Catherine, you've got that crystal ball. What does it tell us?
Oh, and more. And I would love to get your gentleman's opinion on what you think will happen in 2014. But looking back in 2013 and what we know will be coming up in 2014, there is the new laws that have an impact on the mortgages, and how it's going to be. And they've said that there's going to be more requirements. It's going to be harder to get approved for a loan. The process will take longer.
That's good. That's actually good for Mark.
Good for hard money guys.
Yeah.
Yes, exactly. That's one aspect. There is the Federal Reserve. They talk about for the last 8 months they just tease everybody with their discussions about quantum easing and whether they're going to ease their policy or not.
Did you say quantum easing?
He did,
Is that like
yes.
some kind of physics that I don't know?
It's even beyond me.
Quantitatively
Is it
so.
quantitative?
Quantitatively.
I don't know. I kind of
You
like
gotta tease
quantum.
it. Yeah, I
Oh,
like
there we
quantum.
go.
like quantum.
Quantitative.
Yeah.
Excuse me.
That's okay.
Quantitative.
It works.
Okay, we're not
It is a
picking-
Monday.
It works for me.
Yeah.
It's quantum hardening.
Yeah. The
Yes,
QE.
it is a Saturday.
Too much
and-
wine at Thanksgiving.
QE2.
We all had a hard Thanksgiving, I guess. So
Yes.
that's okay.
Thank
But
you.
go ahead.
With the cider, the hard cider.
On my notes only said QE. I got
I
too
don't know.
tired.
Yeah, well, it's the tryptophan. It's still.
So there's that
A
aspect.
trip to where?
No, go ahead. With the turkey, yes.
There's that aspect, and that has been an impact and has had an impact, I believe, on the economy and just the decisions that Americans have been making. We just talked about Walmart, and sales are down. People are holding off on purchase. Are they holding off on purchase because of this uncertainty? So in addition to just the Federal Reserve, then there's just the federal government and their budget, and it seems like every 3 months or so there is a budget deal that must be decided and always gets down to the last minute, and the last time was in October when they went after the last minute in that decision. So I'm kind of curious to
That'll
see.
start the year.
So what you're
Coming
saying
in
is
in
Exactly.
January.
So what you're saying is there's a lot of variables at play here that can affect what happens to the stock market, the real estate market, interest rates, the economic growth, GDP.
Exactly.
In the midst of all this uncertainty, the stock market is reaching its highest levels ever.
Yes.
Right, so are we in a bubble? Those are the new articles. So we've got
That's-
articles
Well,
this
the-
quarter about the real estate bubble and the stock market bubble now, and which I don't know that I believe either of those cases.
I don't think there's effervescence there as much as some people say. I mean, the stock market is at the highest, but the price to earnings ratios are not at the highest they've ever been. They're certainly higher than normal, but within an acceptable range, don't you
So
think?
yeah, I think so. But going back to these predictions for just a minute. Okay. So
She didn't actually predict anything.
Well, no, I'm
She
sorry.
said
didn't.
there's a lot-
I know. I'm more.
She said
I'm
there's a lot of variables out there that are going to
That's
impact
true.
what
Yeah,
happens
that
next
is
year. So
correct.
something's going to happen next year.
Exactly.
Okay,
So-
I'm gonna be a total
then-
CPA.
then the
It
com-
It
depends.
depends.
So uncertain.
Okay, so hold on now. So these new rules are going to be good for you, Mark, in the hard money loan business.
Well, the new mortgage.
The mortgage.
The
Yeah, what
new
are they-
mortgage rules, people
qualifying mortgage.
already are worried
It's-
because they're already in
It's going
effect.
to be
actually.
good for you, Catherine,
facto,
because being
yes.
a CPA,
Yes.
people are going to come to you saying, Catherine, help. I have no idea what's going on.
Explain the
Explain.
healthcare law and what does this mean to me?
Or-
Everything.
Or as Ricky used to
You
say,
did read it, didn't you?
explain this to me,
Oh.
Lucy.
Explain it.
Okay, and will this be good for you, Robert?
Well, will it be good for me? If I can explain to people when they come to me and say, what's going on, I'm not understanding it, like some people did today, that's good. People are wanting some clarification and they're uncertain as to what they can qualify for, and I can certainly help assist them and try to clarify things for them. It's not that much different than it's been, although in the last 5 years it's been different and changing
It's been
all
a
the
wild
time
ride.
in the
Yes.
same direction. Always more difficult for people to qualify for a loan.
Always. Okay, we're going to get into a lot of that a little bit later on. We're going to cut to our first commercial break. Question again, the theme is the movie A Christmas Story. Remember in 1983 with Ralph and all those fun things? Okay. What was the weird prize Ralph's father so proudly displayed for all of the neighbors to see, much to the dismay of Ralph's mother? The first three callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. And by the way, if you ever watched the ESPN show Pardon the Interruption, they have all these kind of weird things up there with Kornhauser and the other guy. They actually have this as one of their props.
Oh, really?
Yeah. Don't touch that back. Don't touch that back. Don't touch that dial, because when the best of investing comes right back, we've got an interesting article here about free speech and how free it ain't. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my co-host, famous Mark Hahn of Pacific Private Money, famous Catherine Harris, CPA, Karate and Karate, and famous Robert Schiff of RPM Mortgage. When we cut to the first commercial break, we asked this trivia question. Again, the theme is the movie A Christmas Story, which it plays like 24 hours a day, right around Christmas time. At some point, I just gotta start going stuff on TV. I have to change the channel. Okay, what was the weird prize Ralph's father so proudly displayed in the window for all of the neighbors to see, much to the dismay of Ralph's mother? Catherine.
It was Fragile.
Fragile.
Because it's from Italy. Right? It was a lamp, a lady's leg lamp. I guess
That's
is the
right, a
best way to
leg
describe
lamp.
it.
Very good, very good. Okay.
Leg of lamb.
Yeah.
Very good, Mark. Oh, he's such a funny guy. Okay, so I'm looking at this this article has been around for a little while, but I thought it was kind of interesting. It was talking about some company where this lady decided, because she ordered stuff and it didn't come, she couldn't get her money back. I mean, there's just one complaint after another. She decided to write on one of those websites about,
Like a Yelp
Bad
type
review.
Yelp
of thing.
type.
Yes.
I think it literally was
Oh, okay.
Yelp. And so she is now being sued for giving her opinion, which was fact, by this company, because they say that she should have read the fine print when she clicked the I want to purchase, and it says that in an effort to be fair and honest, blah blah blah, preventing libelous, thank you, content. Your acceptance of this sales contract prohibits you from taking any action that negatively impacts this company, its reputation, product, services, employees.
You give up your First
Stop
Amendment. You give up
it.
your First Amendment rights.
So that's the EULA, that they are similar to that when you buy software. That agreement you're not supposed to. EULA, EA,
Whatever.
whatever.
It sounds like Ebola.
Ebola, no, not Ebola.
And it says here that should you violate this, that you provided a 72-hour opportunity to retract it. Otherwise, we're gonna bill you for $3,500 in legal fees and court costs. And they have done it. They've actually. I'm thinking.
Were they successful?
Well, don't know yet.
So then she could retract it.
Wait, let me
and
back
then
up.
go on the Yelp and say, I had to retract the following statement to avoid.
You know, that's actually what she probably should have done. That would have been good advice. She ignored it. So they went ahead and they are suing her. They hit her credit report. She's trying to refinance, and her credit
Oh,
score's down.
God.
And they're saying you got to pay this off before we'll go ahead and do it. So
That's really interesting. I don't know how I feel about that because I do sympathize with a lot of the businesses out there that have suffered from, crazy people who've done negative Yelp reviews that are unwarranted.
well, they're blackmailing them. I've heard of restaurants that are saying someone said I will put in a bunch of negative reviews unless you give me a $100 certificate to your restaurants.
This is a way to battle back.
Is that why when you go to restaurants, all the waiters have recorders hidden?
Yeah, they should. That's for sure.
Yeah.
Okay, let's jump into a little email time here. Catherine, an email we received for you. It says, how important is life insurance? And why are they asking you this question, being a CPA?
Well, I think it's when you visit with the CPA, we don't look at just a tax return. We go beyond that, past the tax return, and look at some of your investments and look at the entire picture of where you are in your life, and make sure that you are as complete as you should be given where you are in your life. When you're in your 20s, or if you have children, or if you're in your 50s, what you need and the type of investments and what you need to have in your financial planning and to be financially healthy changes. And I think we're the first step. We're like your primary doctor before you go to see a specialist. Is at least kind of say, hey, that you've got an investment here, you've got other investments that may not be. We could give you the best results. And the most important one thing that's very important. Some people don't realize some of the basic things that they need to have is life insurance.
Okay, so you guys don't sell the life insurance, but you'll maybe look over their portfolio to make sure, let's say, that they have it or that sort of thing?
Definitely, or just it's one of those questions when I'm sitting down with a new client is if I see that you have young children, I will ask about life insurance. Or if you are somebody who is the sole proprietor. See, I'm living all day today. If you are the sole provider of income into your home and you have somebody who depends on you, you need to have life insurance. And people oftentimes don't think about that. They also may not think about long-term disability and other insurances that you need in the future should something not good happen. Trying to make it as nice as possible.
So when people come to you to
unexpected.
get your advice as an accountant, you're actually performing a service more like a financial planner, not just looking
Well, kind
at
of a
the
well-rounded.
More
A lot of financial
we
planners
won't
don't know
go
about
to that
taxes,
extent, but we will, when we see something wrong or something that is the obvious, we'll bring it to your attention. We don't just stop and just hand you a tax return.
But,
We will
that's
then
really,
give you an advice and recommendations of who you should see.
that's really good because a lot of times accountants are just going to do what they're instructed. Do my tax return or provide a financial statement for the bank. But it's kind of nice that you're sort of taking the initiative and asking them ahead of time for that.
Yeah.
Okay.
must
tell you
make,
from
must make for happy clients also.
Yes.
Yeah. Sure.
I'll tell you from experience, many CPAs, even though they say, they'll be proactive in working with you for planning, really just do the compliance work, and
That's a
that's
good
it.
point.
And you never hear from them, except when they're asking for your tax return information for preparation. And that to me is very disappointing when you can't rely on your CPA to be part of your team to help for planning and strategy.
And I like that, and I wanted to ask, when it comes to life insurance, I did want to direct a question to
Yes.
you, is just what your opinion is about, for somebody who is in their 30s or their 40s who have young children, what would you recommend for life insurance, whether you think more of a term or you think whole?
Generally speaking, what I found is that if they're healthy and they're nice and young like that, we can get them a dirt cheap policy. I just gave someone a quote who's 28 years old, and the premium I think is locked in at $700 a year for $1 million for 30 years.
Oh, wonderful.
So in 30 years, a lot of things will change. They'll build up their portfolio. I'm not going to be like one of these typical insurance guys who go, oh no, you got to always buy the most expensive. What pays me the highest commission? That's crazy. But that in saying that though, if somebody's got a good amount of money that they need to invest, if it's done correctly, they could potentially get a whole life policy that'll give them a nice tax-free rate of return, provide them the insurance, flexibility, and we generally push it almost to the limit of what the IRS will allow. So, they came up with these things called modified endowment contracts. Basically, it was such a good deal for the investor that the insurance companies came in, the IRS came in and said, wait a minute, this is too good a deal. You can't invest $800,000 in a $1 million policy. That's just, you're getting too much of a tax-free benefit. So if you hear that from the IRS, gee, I guess you should probably try to push it to the limit, because that's a good thing. So if it's done correctly, and the only way to do that is to run the numbers and make sure that people know how much it's going to cost. But usually, young family, they can buy a good, cheap term policy from me, of course, Edward Brown, and then they can invest somewhere else.
So
like
when you
market,
say term, it doesn't mean just for 1 year.
No, they could buy that, but I don't recommend it. We can get them cheap term for 10, 15, 20, 30, even 35 years.
And what that does, that provides a assurance that should something happen and you still have young children, there is going to be tax-free money there if we were to pass away that they could use to buy a house or provide the support that's necessary until those children are usually 18, 25. So that's why you usually go
and
for that
I'll tell
20
you, you don't think it happens, but my mom, my dad was the sole provider, and my dad died at age 53, and he had a $25,000 policy of which he borrowed 10. So my mom got $15,000. We literally had to rent rooms in the house. We could have had not a sitcom, but a reality show of that. So, for like this one guy, $700 a year locked in for 30 years. Now he can cancel at any time. So, he hits the lottery or something, just cancel the policy. But the insurance company cannot change it for 30 years. Can you imagine the peace of mind of just knowing, just don't even have to think about it?
And that's one thing that you just said, it will never change after the first year. Nothing. I don't think anything can be like that except possibly a mortgage.
And let's say in 15 or 20 years from now, he's still paying only $700. I said there, okay, we got to cut out here. Here's our thoughts for the day. Rodney Dangerfield said, I could tell my parents hated me. My bath toys were a toaster and a radio. And Bill Cosby said, a word to the wise ain't necessary. It's the stupid ones that need the advice. That's words of wisdom there too. Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. 5 seconds to spare. I like it.